So I'm going to talk about Bitcoin lending and yield and understanding the risks that are related to that and why they arise, sort of the natural interest rate for Bitcoin, I guess. So Bitcoin is, people talk about Bitcoin as an interesting collateral because it's bearer. So if you provide it as collateral, it's sort of a kind of hard asset, right? Other kinds of assets are not quite as guaranteed. So you're relying on a custodian or relying on the borrower to not pledge the same asset multiple times. But because Bitcoin is like a gold bar, if you give the gold bar to the bank, they know they have it. There's no possibility for you to borrow against it multiple times. So in mortgage lending, there's a kind of scam where people try to take out multiple mortgages in parallel and, do it on the same day, complete on the same day, and then the lenders do a check to see if there's another mortgage, and there isn't. But tomorrow there are 3 mortgages on the same property, right? So that kind of thing's not going to be possible with Bitcoin because you can't, duplicate it, and there's, the transactions are non-double spendable. So only one only one lender would receive the Bitcoin collateral and therefore release the loan. So it has that kind of bearer advantage, even though it's electronic. But people who are going to lend against Bitcoin are going to want the Bitcoin as collateral because that's their safety. They don't want you to promise to give them the Bitcoin because they're worried that you might change your mind or that you might lose the keys. And so now you have a different problem. As the borrower, you give somebody else your Bitcoin that they could lose the keys, or more likely and quite common in the fine print of the collateralized lending is that the lender is allowed to lend the Bitcoin to somebody else. So you think, well, I gave them the Bitcoin as guarantee that I'm going to repay the loan, and they charged me a certain interest rate, but actually they're trying to get an even higher interest rate by lending your Bitcoin to somebody else, sometimes without security. And so what you think of as a low risk proposition that they're going to cold store it turns into a high risk proposition, because as we're going to talk about, the main way to create yield on Bitcoin, which has a low natural interest rate, is to lend it unsecured to other people, like hedge funds, such as Three Arrows Capital, who famously failed. So I was talking about that sort of relending. So that's called rehypothecation and is very common in a financial industry. So, people think that they have stocks in a brokerage account, but if they read the fine print, the brokerage is allowed to lend the stocks that you think you own. And so, in extremis, like in the worst case, the broker could come unstuck. They could have lent out. They could lose control of their risk and end up not being able to give back all the stock because they lent it to somebody else who lost money and defaulted, and they ended up holding a loss that they realized, and then they don't have enough money to basically rebuy the assets that they've lost by over rehypothecating. So now, of course, it's attractive for the financial players because they can make more money and they can lend the same asset multiple times or do fractional lending. But it does sort of magnify risk, increases overall leverage and default risk in a financial system. But it's sort of being replicated in the Bitcoin space by some of the players. Of course, some of those things have come to reality in the last sort of 3 months or so, that different DeFi-related lenders that were taking collateral undersecured have actually failed, and that's partly made more likely by the rehypothecation. Now, there are some lenders that don't do rehypothecation and take steps to prove to the borrower that the coins are not being lent out again. And the way they can do that is typically with some kind of multi-sig. So they will, as the borrower of US dollars, stablecoins or something, you're going to put the Bitcoin collateral into a multi-sig. So there's a few companies doing this, Unchained and HODL HODL. And the as a borrower, you put the bitcoins into a 2 of 3 multisig. You have one of the signatures, and the platform has one, and the lender has one. Sometimes the lender is the platform itself. Sometimes it's a peer-to-peer lending. So HODL, the lender, is another user who's lending the stablecoins. I think in Unchained's case, the third signature is a law firm as a kind of independent party, and they're lending their own capital or capital from another bank or something like that. But at least you can see that in the HODL case that the coins are not going to move unless one of the other parties, unless both of the other parties collaborate or collude against you. So there is a rationale for, in a HODL case, for the platform to take the collateral, which is if the borrower gets liquidated, there's a loan to value ratio, and if the price falls too much, they could need to give the Bitcoin or part of the Bitcoin to the borrower to repay the dollars that you've borrowed. And so in that case, sometimes the borrower gets annoyed and won't release the keys. And so in that case, the HODL and the lender will sign to take the collateral. But it's manually managed. There's 24 hours, and it's relatively flexible because the borrower can change the loan to value ratio in a number of ways. They can partly or fully repay the loan in dollars. They can add more collateral at any time, and there is 24 hours notice once it gets within 90% of the liquidation level. I would say it's still fairly risky because Bitcoin can move rapidly. So I think what I've seen people do is take out a loan and then add extra collateral to just make it very low LTV and watch the price and try to keep it that way. So if the price has moved a bit, they'll add some more collateral or part repay it. Now the platforms that are providing loans without collateral are typically doing unsecured relending, and it's not always obvious who's doing what. But there are a number of exchanges that have, earlier in the year, offered yield on Bitcoin or other assets on the exchange, and the natural rate of interest on Bitcoin is very low. So typically they're actually placing the money in somebody else, in Celsius or 3 Arrows Capital, or in another fund that is placing it in one of those things. So that's basically what's happening. So now, why do people want to borrow against Bitcoin? So a number of reasons. One is tax planning, to sort of defer a capital gain or to convert a capital gain from a short-term capital gain to a long-term capital gain. And in some countries that there are different rates, or there is no long-term capital gain, like the long-term capital gain rate is 0%, but the short-term capital gain rate is some higher percent. And so if they need to access to some money, they can borrow temporarily at a low LTV to just get some cash for something they need to spend this year, and then next year they'll sell a small amount of Bitcoin with lower tax and repay the loan. So that's one approach. It seems like a lot of people are using it for leverage, which is high risk. So they'll borrow dollars against Bitcoin and then turn around and buy more Bitcoin with the dollars. And that is, Bitcoin's already volatile. That is adds to your risk. And there's a saying that if you are leveraged, it won't turn a good trade. Sorry, it won't turn a bad trade into a good trade, but it can turn a good trade into a bad trade. In other words, you can want to hold for the long term, but you're forced to sell when you don't want to. So from that point of view, if Bitcoin is volatile, maybe you're better off without the leverage, because you could end up with less Bitcoin than if you'd done nothing. And I think another general problem with actually any kind of frequent trading is that sometimes people don't account for taxes, so they keep trading and they reinvest 100%, and then if their collection of Bitcoin and other assets falls at the end of the tax year, they can end up with a tax liability which is a very large proportion, or even over 100% in the worst case, of their remaining assets. And that obviously is very distressing for them. And so I think the point is, if you're going to do that, you should set aside the estimated. So if you realize, again, you should set aside the capital to pay tax. Otherwise, you're taking an unsecured loan from the country you live in's tax department, and if they make a tax demand, that's kind of like a liquidation event, right? If you don't have the capital. I think another reason why leverage is higher risk than people expect is effectively you're using Bitcoin as collateral to buy more Bitcoin. So if the price falls, you're experiencing the fall more rapidly than you expect because the collateral falls in value and the asset falls in value. So if you model it out in a spreadsheet or something, you'll see that this so-called quadratic effect, and so it doesn't take that big of a fall to create a liquidation risk. So it's pretty easy for that to get out of control. So I give some examples. And that's the quote I was talking about. Leverage can turn a good trade bad, but not a bad trade good. So be careful. This is the 2 of 3 that I was talking about with HODL HODL and Unchained. So the HODL HODL case is interesting. It's fairly trustless, and it's there's not a great deal of documentation to take out the loan. Like basically, you just sign up with an email, a password, and HODL HODL doesn't know your. It's effectively non-KYC because really it's a loan secured by Bitcoin between two users. And so HODL HODL is not really part of that and doesn't need the kind of usual loan documentation that you would need for a bank loan, for example. And HODL HODL's only part in that is to act as the arbitrator if there's a liquidation that's contested or something like that. And I think the other advantage of the 2 of 3 is if the HODL HODL went out of business, the lender and the borrower could actually release the collateral at the maturity of the loan without involving HODL HODL, the platform. So, I think the thing to watch out for this, it's a bit like cold storage, storing your own coins. If the lender and the borrower lose the passwords, there's no recovery. Because really that 2 of 3 multisig, you are effectively generating keys for it using the various passwords, and HODL HODL is not a custodian, so they can't help you recover it. So, I think if one of the parties lost the keys, HODL HODL could possibly recover from it. But if both of the parties lost the keys, you've now lost the Bitcoin and maybe the stablecoins too, depending on how they were stored. I mean, typically people are going to spend the stablecoins straight away, or they wouldn't have borrowed them. But losing the collateral is bad. So there's another kind of the other case, which is a corporate lender. So I think HODL HODL has some corporate lending that typically requires more KYC because the lender is ultimately a financial institution underneath. And there's still a 2 of 3, but it's less. I think there's more prospect of funds getting frozen in this one through, a court order or something like that, if that was to arise, because you only have one key, so you can't override it. With the HODL HODL peer-to-peer lending, it's between two users, and the other user, nobody knows the names of the users. The users don't even know each other's names necessarily, and so it's much harder to contemplate a court order affecting it, and there's no kind of company with corporate lawyers that has to make a decision based on a legal request. So I would think that Unchained Capital is going to be like that, and HODL HODL have a new feature, which is corporate lending. So where the lender is a bank, but the borrower is a user, so it's a kind of one-sided loan, not a peer-to-peer loan. And of course there's more documentation because of the nature of the lender. So I think the problem with why this arises is just to look at how Bitcoin yield is generated. And the reason that there's an imbalance between US dollar yield and Bitcoin yield in the Bitcoin ecosystem, and therefore why Bitcoin yield is going to be much higher risk than dollar yield. So the reason is there's basically a shortage of US dollars in the crypto exchanges and in the Bitcoin ecosystem, because anybody, most people with US dollars get tempted to buy more Bitcoin. And so if you want to borrow off them, you have to offer them a really high interest rate before you persuade them to take your interest instead of buying Bitcoin. And so, the interest rates prevail above 10%, often above 15%. And so, you can borrow dollars using Bitcoin as collateral, but if you were to borrow Bitcoin using dollars as collateral, which would provide an interest rate to the lender, that's unattractive, because if you have some dollars and you're looking for yield, you just lend the dollars out. You don't borrow Bitcoin to then collect a low interest rate on the Bitcoin you've borrowed and forego or give up a high interest rate on the dollars. So it's very hard to expect a borrower of Bitcoin to provide collateral. Now, on exchanges they can do it because they have margin management. But you have the same problem, which is an excess of Bitcoin. So some people are leaving their Bitcoin on exchange, and there's more Bitcoin available to borrow than there's demand in the market. So consequently, the interest rates to borrow Bitcoin with margin management, which is kind of collateralized, right? They would liquidate it if it falls below profit. Then as a result, the interest rates are like 0.5% or below. And arguably, that's not really worth the annual custody risk of leaving Bitcoins on an exchange. So it's not a great solution. So in effect, most Bitcoin yield that is above 0.5% is somehow unsecured, probably in a not very clear way. It's off. There are multiple layers of it, right? So some exchanges are offering yield. They're maybe not explaining how they get yield. Really, they get yield from relending the Bitcoin to somebody that's doing something managed, like another lending platform or a DeFi ecosystem or a hedge fund. And so you may not even be getting the benefit of all of the yield, because each of the intermediaries is taking a cut, taking a commission on passing that on. And yet, ultimately, at the bottom, it basically has to be very high risk. It has to be unsecured, because nobody's going to pay a high interest rate on Bitcoin without there being no security. I think the other kind of yield you can get is sort of fake yield, so incentives to put money into DeFi schemes, and there's a different kind of risk in there, which is, a collection of risk, like a technical risk that there's a bug in the code, or sometimes the architecture of the code has a kind of master key, so the insiders, who are sometimes anonymous, could take the collateral, and it's even in the code, apart from code bugs. And the other problem can be that the scheme that is creating a yield is based on illiquid collateral, or the yield, so they have to create an incentive for people to put assets into a DeFi product, and so they'll often offer an artificially high yield where there is not really a borrower. And so Alan Farrington wrote about this at various points, and basically asked the question of, where is the yield coming from? Is there a borrower? And typically there is not. So effectively, the yield is actually sort of paid from the profits of the DeFi founders or foundation or company or something, right? So in the case of Terra Luna, which infamously collapsed and was part of the pullback in Bitcoin price and in the whole market due to a number of due to contagion between different lenders that were exposed to them. In that case, I think Terra Luna, the company, held a lot of pre-mined coins, and so then they offered a kind of connected yield platform where you would buy Luna coins, exchange them for algorithmic stablecoin called US Terra, and then you would stake the US Terra and get 20% interest. And so the question is, where does that 20% interest come from? It's a very attractive interest rate, right? And the answer, it seemed to be that they were selling Luna coins that they had created as an, pre-mined as part of the setup. As the market was growing, because people were chasing this 20% yield, they were selling some of it and using that to pay into this pool, to pay this artificial interest rate. So it's not really an interest rate, it's a kind of incentive scheme, and it has some Ponzi-like aspect because they're effectively taking money indirectly from new money coming in and paying it to existing people as an incentive to stay in the system. And as soon as people get nervous and leave, there's a risk of collapse. And in the case of Terra Luna, most of the collateral was the Luna coin itself, and the value of the Luna coin there's no fundamental value other than the long-term viability of the platform. So as soon as it started falling rapidly, and the collateral value dropped below the value of the US dollar stablecoins in circulation, it became obvious to everybody in a rush that you've got to get out now or it's going to zero, and so everybody rushed out and it fell to zero. So that's an example of DeFi risk, I guess, and the CeFi risk is hedge funds. And of course, you wonder, why are the hedge funds borrowing collateral? Well, they're probably putting it into DeFi because they have a 24/7 trading desk. They have maybe a bit of an advantage in being able to trade all the time, have professional traders look at it, try to get out before it collapses. Maybe they know there's a risk, but they think they can get out faster and make money. And also they're gambling with somebody else's money, the people that they borrowed the money from, right? In the case of Three Arrows Capital, it seemed they borrowed a lot of money unsecured from other funds. So they were gambling with other people's money and got exposed to some of the DeFi failures as a beginning of a problem for them. So arguably, getting an interest that comes from a hedge fund is a bad trade because you're getting, an interest rate and they're taking a risk with your money. So obviously they're not going to do that unless they make a high return. So in other words, you're taking a high risk, but somebody else is taking the high return. So if you actually wanted to do it, maybe you'd be better off to participate in a hedge fund directly, right? I mean, the risk is no better, but at least you get a share of the return. On the platforms, like a number of the exchanges have margin lending platforms. Like Bitfinex was one of the earliest to provide peer-to-peer margin lending. The rates are very dynamic; they're very real time, and you can, lock them in. The borrower can cancel at any time, but the lender can't, and so you've locked it in at the current interest rate. As a lender, you've locked in the Bitcoin or the dollars at the current interest rate for a chosen period varying between, I think, like a couple of days and 4 months. But it's a market you can play. You can sit there and replace loans and monitor when they get cancelled. And effectively, what's happening is people who are doing margin trades, they can either manually participate in the margin lending platform, or they can just click buy with margin, and the system will automatically take the cheapest loans on the market. You have to watch it as a leveraged, as a margin trader. If you buy Bitcoin using Bitcoin as margin, you're borrowing on this lending market. You should look at the lending market and look at the interest rates, because it can be high because when everybody wants to buy at the same time, that pushes up the marginal lending rates. And if you get locked into a high one, that will be expensive to you. And as the borrower, you can actually refinance it. So you can borrow some more and then cancel the expensive ones when the market is calmer, if you're trying to hold that position for longer. So I think part of the story is that people should be generally suspicious of unrealistically high yields. So, I think probably more than 1% is already suspicious on Bitcoin. If there's no clear story about it not being rehypothecated, and there's not some evidence that it's not rehypothecated. I mean, you can read the fine print, but they could change their policies after the fact, and you can't really verify it unless you're part of the multisig and you can see the the coins are not moving. On US dollars, yeah, you can get a higher interest rate, but it is variable. The HODL ones are longer duration, so you get, as the lender on a HODL, the borrower can't cancel early. I mean, they can cancel early, but then they pay the term interest rate, so they don't save on the interest rate. The Bitfinex ones can be cancelled by the borrower. And the HODL rates are market, so the borrower and the lender can propose LTV, they can propose the interest rate, they can propose the duration, and it's just a market. You can create an account on the system, which is just an email sign up. Be careful not to lose the passwords; they're just as important as seeds. And you can propose as a borrower what you're willing to pay. As a lender, you can propose what you're willing to accept, and then either side can accept. And the rate's fixed for the duration, so it's more predictable for the lender, and I think quite safe, relatively speaking, compared to even platform risk, because you can see the Bitcoin collateral is not rehypothecated. You're part of the multisig. If you are getting yield, it's good to ask questions about where that yield came from. Now, some of the yield I think is actually, there are different players in the ecosystem. One of the bigger ones is Genesis, which is part of Digital Currency Group, and they, some smaller companies like startups were creating yield by passing it on to them. So taking a bulk loan or providing a bulk loan, represent multiple users to Genesis, and making a markup on that. And I think Genesis was basically saying that they have diversification. So if one customer, if they are doing relending, I believe, and if one of the people they relend to goes bankrupt, they have diversification, so they could absorb that. And so that was the assumption, that this was the kind of least insecure of the rehypothecation-based lenders because of size, and because they have their own collateral, their own capital as a backstop, and they're diversifying their risk across people they're lending to. But ultimately, they themselves ran into problems due to, I think, undersecured, like partly secured but undersecured loan to Three Arrows, which they liquidated, but it was difficult to liquidate in a falling market, and so they ultimately, I think, lost about $1.1 billion and were recapitalized by the parent corporation. So I think, for the other lenders, they were covered, but that was a risk moment, even for arguably the too big to fail kind of lender in the Bitcoin sort of crypto space. It itself almost ran into trouble. So it shows that even the blue chip at the top of the rehypothecation game has material risk. I think lending on platforms is better in a way because they have margin management and they're not under collateralized typically. But you have to keep an eye on platform risk because there are exchanges that have gone under. So look at the security history of the platform and how many years it's been around and the management team and that kind of thing. And you can also diversify across platforms. And some of the exchanges themselves provided undersecured margin to Three Arrows Capital. So I believe Deribit did that and ended up with some loss, which they were able to cover ultimately. Okay, it's coming back. But it shows that, even platforms have risk. Even if the platform is sound, they've effectively provided under-collateralized lending to hedge funds. And, it's a competitive world in the exchange space. So, the people that generate a lot of trades are some of the funds, and they will go to the exchanges and say, if you want us to trade on your platform, you have to give us some credit. And so that was the de facto situation before the 3 arrows. I expect that there will be very few people offering under-collateralized credit on exchanges now defensively. So if you're on the conservative end of it, of avoiding risk related to yield, then hold your own coins, or if you're using a custodian, try to get an understanding of how risky they are as a company. There's some very big conventional players in the custody space. Probably they don't provide service to individuals, but they provide service to other companies. So I'm particularly, thinking of some of the US banks and Fidelities in the custody space. So it's an interesting kind of custodian because they are so large that if they lost some Bitcoins, they could buy them back. That's the point where a startup wouldn't have the capital to do that. If they have a technical failure, it's probably game over. You can get insurance on some things. It's quite hard to get insurance in Bitcoin though. The risks are large and hard to quantify, so the insurers either won't insure or they'll charge a lot of insurance. So it tends to mean a lot of stuff is not insured. If you are doing self-custody, good backups. Don't. There's a potential problem where people try to be clever in sort of backing things up, and like they hide things and they hide them too well, and then human memory is not as reliable as we imagine it is, and so they don't think about it for a couple of years and then they forgot where they hid it too well. So keep it simple. Multi-sig is good, but if you make too much of a complicated backup strategy, you could fail for a different reason, not that it got stolen, but that you failed to follow your own instructions. So maybe write some instructions for yourself or for somebody in the future who might have to recover the keys. There are some sort of new, there's single sig and there's multi-sig, but there are some more adaptive things now. So there are things where the number of signatures required shrinks over time. So maybe you start with a 3 of 3, and after a year it becomes a 2 of 3, and if you lose a 2-factor, it becomes a 1 of 3. So there are things like that. So the Green Wallet has a kind of 2 of 2 and a 2 of 3 option, where one of the signatures is a 2-factor authentication device, which is co-signed by a server only if you pass the 2-factor authentication. And the point there is if you lose the if you fail to back up the 2-factor authentication, it's not really a seed, but the backup for a Google Auth. If you fail to back that up or you lose it, then after a period of 6 months or 9 months, you're able to, there's a time lock, and then you're able to spend it without the 2-factor protection. So it's a kind of way to, get a benefit of 2-factor in a multi-sig that shrinks to a single sig effectively later. And that can protect against some backup failures. So that's what I have. We're a bit, so we've got some time left for questions. I think we have like another 10 minutes, if there are any questions. Hang on, there's a microphone back there because people can't hear you.
So Wouldn't it be best if there was a solution for earning yield on Bitcoin on a sort of a protocol level rather than having any sort of counterparty or custodian risk with any lenders out in the space, as this is more like a high risk undertaking?
Right. I mean, it would, but I guess there might be, HODL HODL is close to that in the sense that it's peer-to-peer and you can self-verify that the collateral is not being rehypothecated. There's still a small chance, if you're paranoid about it, that the platform could be corrupt and wrongly collude with one of either the borrower or the lender to sort of wrongly take the collateral or wrongly release the funds or something. There's probably a prospect for some sort of simple smart contract loans. So there's some smart contract for that kind of thing on Liquid, which actually creates a kind of token for the loan. So the collateral for the loan goes with the token, and so you can actually resell the loan, which is interesting for the lender. I think one of the downsides of HODL HODL for the lender is Bitcoin price is high, they lend some dollars into it for a year, for 10%, 15%, and then the Bitcoin price falls, and they wish they had the dollars to buy some, and it's locked up for a year, right? So if it were tokenized, firstly, you might have less sort of third-party arbitration risk, but secondly, you could resell the loan, right? So if you have a tokenized representation of a loan, you could sell it to somebody else. Now you might have to accept a lower interest rate, so give up some or all of the interest. But if you want the capital back, that might be preferable to the lender. And so if the lenders have more flexibility to resell, they're going to be more willing to lend on a longer term, right?
Is there a market on Liquid?
Those loans are like development stage, so there's not a market for them. But there is a kind of trust. There are a couple of trustless marketplaces like SideSwap and TDEX, which give atomic swaps for liquid Bitcoin, so liquid Tether, and also trustless limit orders, where you can sort of sign a limit order and place it either in a distributed system, like broadcast it with TDEX, or place it on a non-custodial order book with SideSwap, and then the maker. So basically, your Bitcoin is still in your wallet or your Tether, and you're saying, well, anybody can buy this Bitcoin if they pay, $21,000 of Tether to this address, and that sort of half-signed transaction sits on the exchange. So, if the exchange gets hacked, the hacker has to pay the asking price, right? So there's not really the same custody risk, and so that kind of limit order, like that tech is reusable, right? So if you had tokenized loan, you could use it. So it's a sort of non-custodial kind of environment to do interesting things.
When you are talking about borrowing and lending stuff, do you include derivatives and futures stuff? Or if not, what do you think about how we do this to do leverage stuff and try to get more from your Bitcoin or from your dollars?
Yeah, I mean, so we have like Blockstream research released some implementation and a paper on sort of trustless options. So most options today are in Bitcoin are on platform. So like Deribit, BitMEX, Bitfinex, a number of exchanges with options, and that's okay. But if the market gets very volatile, the exchange could become insolvent in the worst case. Plus, the exchange could get hacked or something, right? But I mean, generally they work, but they do have insurance funds, which is basically to account for the case that there's a price discontinuity, and then both sides can lose or something. So the sort of non-custodial option is basically a covered option. So the collateral is attached to the option, and it doesn't need a price feed actually, because the incentives are such that you wouldn't exercise the option. So there's a maturity date, but after the maturity date, you wouldn't exercise it unless it made a profit. So the protocol doesn't need a price feed to support trustless options, and these options are tokenized, so you can resell them before maturity.
Most are perpetual.
Well, these ones are expiring, but perpetual, yeah, I mean the perpetual is a sort of way to get leverage, I guess, right? So it's perpetual future rather than an option, and I think usually those are designed for higher leverage than margin trading. I think, like for example, Bitfinex has a 10x. Yeah, I mean they have like 10x leverage on Bitcoin on margin and 100x on leverage, minus a 0.5% buffer where they will liquidate. But 100x is like crazy. But it is a different market. So I think if you were using margin. If you're borrowing against margin, you're always paying an interest rate. If you use the perpetual futures, there's a funding rate, and you can actually end up being paid to be long Bitcoin, which is a curious phenomena. But you can, it just depends on the market. In a bullish market, you will end up paying to be long. In a bearish market, you'll get paid to be long, and it's just part of the free market mechanism. Basically, the reason that perpetual future is a side contract, right? So it's a contract between two parties, and so there has to be an equal number of people short and long. And the problem is there are not. There are a lot more people that want to be long than want to be short. And so the question is, where are you going to find people to be short or incentivize them to be short? So they pay them a high interest rate, and the market pays them a high interest rate to be short, so that there's a matching trade. And how they are, so people are sort of synthetically short. So what they do is they take they take $20,000, they buy one Bitcoin, they use it as collateral, and then they go one time short. So they actually have a very stable dollar position, but they collect a funding rate, and the funding rate is high. So
it's negative for short.
Yeah, so the short is being paid in a bull market, and that's a way to, people are not really short Bitcoin because they have one physical Bitcoin as collateral, and then they have a short, and it completely cancels out. So, they'll still have $20,000 whether the price doubles or halves, but they'll collect the funding rate, and that sort of makes the market work. Otherwise, it would be a dysfunctional market where there's nobody to take the other side. So it can pay very high interest rates, but it's very dynamic. It can change direction hour by hour, or some of them are 8-hour windows, or hourly, or 24 hours. So I'm not sure if there is a non-custodial solution to that, but maybe it could be constructed. But it's a lot of leverage too, so it's risky. You can use those markets. You still have platform risk, but you can use them as a yield strategy, right? So if you have some dollars and you want to collect a yield on it, paradoxically, you can create a US dollar yield by buying Bitcoin and shorting Bitcoin. In a bull market, in a bear market, you've got to sell the short and close the short, accept the loss, and buy back the Bitcoin or something like that, because you can lose the funding rate will go negative in a bear market sometimes. Sorry, in a bull market, yeah.
I have a question. First, thank you for being in Switzerland. It's here. After the debacle we witnessed this year in the crypto market, I think it's important to protect inexperienced lenders, and the yield threshold above which we take excessive risks is a very important yardstick to have when we want to lend our money. And I guess it's based on current financial market, but for people not knowing the intricacies of financial conditions and whether or not it's excessive or not, is there a rule of thumb we can we can use to update these values? Because I guess that, for example, the treasury interest rates is taken into account for that? Or?
Well, it's a bit of a unusual situation because the fixed income interest, so bonds and deposit accounts, certificates of deposit with banks can be, I mean, it's higher now, but last year it was like 1% or less, and yet lending dollars or euros in the Bitcoin market was 10% was realistic, right? You could get Bitcoin as collateral and lend at those rates, and you would wonder, well, why aren't the banks putting the money in the Bitcoin margin lending market? And it's basically because they are scared. They don't understand the risk. There's a platform risk. To them, the platform risk is very scary, and so they won't do it. But yeah, you can look at what the bank's are offering, and if the bank is offering like 0.1% deposit account and somebody's offering 20%, that's suspicious, right? So. But it's hard to distinguish. I think the main point is that it is realistic to get a fairly high percentage return on dollars, but you want to know that it's collateralized and you can verify that there's no rehypothecation of the collateral. But for Bitcoin, that's unrealistic because of the excess Bitcoin, the shortage of dollars and the excess of Bitcoin. It's unrealistic to get any kind of moderately high Bitcoin interest rate. It basically implies that somewhere down there through the resellers is unsecured lending to a hedge fund, which is probably getting the yield from DeFi or option trading or something like that. So I think it's pretty hard to get Bitcoin yield without risk, basically. So it's probably borderline, like maybe you're better off cold storing than collecting 0.5% or something. Or if you're collecting 5%, probably the risk, if you really got the full picture, is not something you would keep doing if you knew what was going on, kind of thing, right?
Hey Adam, you talked about insurance earlier on. Typically, I mean, if you're thinking about companies like NXM and things like that, token holders typically stake their coins to try and insure the protocol, and the yields there are very low. I mean, you try to insure something on Aave that makes lending, you're going to get very low returns. At the same time, it seems like for whoever takes the insurance, it's quite expensive too. Do you think the insurance market really works at the moment in crypto, or what's going on in that space?
I mean, if you try to get insurance for different parts of crypto, it's very hard. I think it's hard for the insurers to insure because they don't know what the risk is, and there are the big expensive failures. They can see that if they were the insurer, that would be a bad trade for them. I think the kinds of insurance you can get, which are lower cost, are kind of stablecoin insurance, which is ensuring that the stablecoin holds its peg, because they can understand that, right? They can look at audit statements of Tether or Circle and see that there's a credible audit report or attestation from a big accounting firm that there are the same number of dollars in different types of short-term investments, which gives them assurance that it should be one for one, right? So then people are willing to insure those, and there are actually like platforms that offer insurance. So if you want to insure them, you can get paid interest to insure them, but then you have to form your own opinion about which ones are risky, because some of them are risky. Like obviously Terra Luna stablecoin went approximately to zero, right? So if you were insuring that one, that would have been a very bad deal.
Hi Adam. Just a quick question. I think on a podcast you alluded to using HODL to hedge your Bitcoin position, taking a loan in USDT. So I was wondering, I know you can set the interest and the term and the LTV. is there any penalization for non-payment? Is that practically taking the loan and then not paying out or not returning? Is that a practical way to hedge your Bitcoin position?
Well, so I did some lending in it, so I wasn't on the borrowing side, but you can, I tried to set LTVs which would make it unlikely that the borrower would get into a liquidation position. And at the time I did it, it seemed, you don't necessarily know what the borrower is doing, but there's a chat box and some of them tell you that they bought, and you ask, well, what did you buy? And it's like, oh, they bought Bitcoin, right? So clearly most of them are buying Bitcoin with it. And most of them didn't get liquidated because there was a point in the market where the price went up. So they actually made, I made my 13 to 16% depending on duration, but they made a lot more because the price went up. But there was one guy that got liquidated because he asked for a custom loan rate and LTV later, which some of the loans came back, so I lent that again, and he got liquidated. And so basically, there's not really an option for the borrower to not, to walk away from the loan, because what happens is the HODL platform steps in and co-signs the Bitcoin collateral with the lender and gives the Bitcoin to the lender. Not all of it, but enough to repay the loan. And then HODL takes a liquidation fee for the manual effort of organizing that, and then the balance goes back to the borrower, or the balance of the Bitcoin. So yeah, it's so I think there's like a 10% buffer because they start the liquidation process, which takes 24 hours, and you can, their support people chat with the borrower and the lender, and they send emails, and so it's possible to sort of negotiate privately between the borrower and the lender and not liquidate it. But if you do nothing, I think the HODL platform people will liquidate it with the lender. And so, as the lender, you lend out Tether, let's say, but you get back Bitcoin. And so if you want the Tether back, you have to sell it. Or you can just hold it if that's what you want to do. Effectively, you just bought Bitcoin at market at that point.